Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Calian Group stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Calian Group is a consulting firm, management, and R&D company. The company is headquartered in Ottawa, Ontario, Canada, and was founded in 1982. It went public in 1993 and trades on the TSX and OTC. It has 4 segments: advanced technologies, health, learning, and IT. To give you some examples of what they do, they were selected by a global satellite communications operator to provide and install new radio frequency satellite ground systems. The company also serves the pharmaceutical and medical device industry. They do clinical trial services, specialty patient support, community care, and other health services. The company receives a lot of their revenue from government contracts. When you invest in a company that receives government contracts, it's almost like guaranteed revenue. We're going to look at the ticker that trades on the TSX, so all the numbers in this video are in Canadian dollars. Let's get started with the model. This is a small cap company, 600 million market cap. They're trading at $54 a share, and they have 11 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have positive free cash flow in 2018 and 19, although it is negative in 2020, and a big positive in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's pretty consistent year to year. Revenue is the sales for the company, and that grows every year. Even during COVID in 2020, they had the highest revenue up to that point, and it grew even more in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, which grows every year, peaking in the trailing 12 months at over 100 million. Below that is operating expenses, and then below that is operating income, which also is the highest in the trailing 12 months at almost 28 million. Below that is the interest they pay in their debt. Below that is other income and expenses. This is the company's gains or losses outside of its core operational business. And the bottom line of the income statement is their net income, which peaked in 2020 at 20 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. You can see in 2020 they had negative operating cash flow. That's because that year they bought $45 million of inventory. When you buy a lot of inventory, that detracts from cash flow. But when you use the inventory in future years, that adds to your cash flow. As you can see in the trailing 12 months, they had the highest operating cash flow. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. That was negative in 2020 due to negative operating cash flow, but positive in the other years. They're mainly funding their business on capital stock. They issued 2 million of capital stock in 2018, then 3 million, then 70 million. Every time a company issues capital stock, that increases the shares outstanding, making your shares less valuable. They did issue $13 million of debt in 2019, but paid down $15 million in 2020. Let's look at the capital structure. $290 million of equity, $74 million of debt. They're 80% equity, 20% debt. Their net debt is negative $45 million. So they could pay down all the debt with the cash on their balance sheet and still have $45 million of cash left over. Their WACC is 8.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 765 million. We discounted those numbers back to today's and the weighted average cost of capital. We get a value of the company of $664 million. We divide that by 11 million shares. And we get a calculated stock price of $59. They're trading at $54, so they're trading at a 9% discount. It is a buy according to the model, but it's really close. Simply Wall Street is much higher than me. They're at $87 a share. They're saying the stock is 38% undervalued. This is a stock price since it started trading, so it has gone up overall. In the first 10 to 15 years, the stock price did go up, but at a pretty slow rate. In the past year or two, the stock has really increased. It looks like it peaked at about $70 and it has regressed a little the past couple of months. This is the stock price the last 12 months. So it looks like it's pretty flat for about 12 months. It did go up to about $70, but the stock price has come back down. They've been paying a 28-cent dividend for quite a while now. Their dividend yield is over 2%. To calculate the dividend yield, you could just multiply the last dividend payment by 4, take that number, and divide by the stock price. They pay out 67% of their net income and 45% of their free cash flow. Their industry pays a 0.7% dividend yield, so their dividend payment is 3 times as large as their industry. Since 1988, they acquired 19 companies. For certain industries, it's hard to grow fast organically, so you may need to acquire companies to expedite your growth. Acquisitions are kind of tricky because you want the acquisition price of the company to be less than the profits you make on that company in the future. Sometimes that doesn't happen. That company doesn't create more profits than the price you paid. But sometimes you have to acquire a company so your competitor doesn't, because you have to always stay ahead of the curve. So they do seem like they're doing a good job at proactively trying to grow their company through acquisition. They have 4 divisions. The first is Advanced Technologies, which works with aerospace companies, cable networks. One of their customers is Sirius, and that division grew a lot from $109 million to $153 million. Their health industry works with defense companies and law enforcement companies. That division is working with the Edmonton Police. And this division had the most revenue in 2020 at $163 million, up a lot from 2019 of $116 million. Their learning division works with health, energy, and government companies. An example of a company they work with is the province of New Brunswick. The revenue decreased from 2019, $63 million down to $57 million. And their IT department works with government, defense, and private sector companies. An example of a company they work with is General Dynamics, and this increased slightly from $54 million of revenue to $58 million. Their stock is less volatile than the market. They have a beta of 0.9, and the stock has struggled relative to the S&P 500, up only 6%, while the S&P 500 is up 32%. The 52-week low was 48, the high was 72, and the stock is trading below its 50-day and 200-day moving average. Only about 10 to 20,000 shares are traded each day on this stock. Almost all the shares outstanding are on float. When a share is on float, that means it's available for investors like me and you to purchase. About half the shares are held by institutions. Examples are insurance companies or hedge funds. And 1.35% of the shares are shorted. If you include dividends, in the past year, the stock has only gone up 8.5%, whilst the industry went up 46% and the market went up 35%. But in the past 3 years and 5 years, they outperformed their industry and the market. Analysts are forecasting their earnings to grow 26%, its industry 60%, and the market 14%. Analysts are forecasting their revenue to only grow 5%, its industry 13%, and the market 6%. In the past 5 years, their annual earnings increased 10%, its industry 20%, and the market 13%. In the past year, though, their earnings decreased 16%, its industry increased 13%, and the market increased 15%. If you invested $10,000 into this company in 2013 and reinvested the dividends, you'd have $29,000 today. That's a 14% annual return. That's a pretty good investment. The biggest shareholder is Fidelity at 7.6%, one of the world's largest asset managers. Next is Mawar, which is a Canadian investment manager. Then there's Manulife, a Canadian insurance company. The next is 1832 Asset Management, which is one of Canada's largest asset managers. Last is Invesco, which is an investment manager with over $1 trillion of assets under management. Let's look at their financial ratios. The average PE in the market's 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 32.4, so investors are paying $32 for $1 of earnings. That's about at the market average. Their price to sales is really good at 1.3, much better than the market median and average. Their price to book is also really good at 2.1, so they have a good balance sheet. And the way you calculate price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $292 million of equity, $123 million of tangible equity, since they have $169 million of intangible assets on their balance sheet. The way a company gets intangible assets on its balance sheet is when they acquire a company for more than it's worth. Their return on invested capital is 8.3%, which is the same as their WACC. They can cover their interest payments 42 times. Their ROE is 6.4%, which is between the market average and median. And they can cover their current liabilities 1.9 times with their current assets. Their current assets are $119 million of cash, $110 million of receivables, and $82 million of inventory. So the company does seem to be well capitalized. They had $28 million of free cash flow in the trailing 12 months, $148 million of working capital. Working capital is on the balance sheet is current assets minus current liabilities. And they pay out $13 million in dividend payments. So they have $163 million of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos on ARC, Copart, Global Payments, Kodak, and Wilhelmina, all in the same industry as Calian. And if Calian has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're a lot better in all the price multiples. They have a higher current ratio than average. They're lower than average in ROE. They're a little better in debt than average. When I convert everybody's market cap to Canadian dollars, they're a lot smaller than the average company, but they do pay the highest dividend. To summarize, I have them trading at a 9% discount. This company is doing a really good job at growing its business. It's really impressive they had the highest revenue in 2020 during COVID, and it's getting even better in the trailing 12 months. The problem is with these smaller companies, not a lot of people know about them, so they don't buy the stock and push the price higher. So a company like this can be profitable, but not a lot of people buy the stock. There might be other companies that are losing money, but everybody keeps buying the stock, pushing the price higher and higher for some reason. It just may take time for people to learn about this company. In the long term, I don't think there's too much risk in owning this stock. It should go up over time, and if it goes down, it shouldn't go down too much. Plus, you get that 2% dividend yield. I rank their free cash flows 4 out of 10, their revenue 8 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.